But how about when people say that paying dividends means the company has no more good ideas for growth? A company that consistently pays and grows dividends over time is showing a strength and stability of their business model and the ability to generate cash flow. For investors, it's another measure we can use to determine how reliable or volatile an investment might be. And growth investors are going to say, exactly. Because the company doesn't have any more good ideas for growth, they're just giving cash back, and that means they're going to grow slower and have a lower return over time. And if investing was done in a vacuum and all things remained equal, then I would probably agree with that. But the reality is that it's not done in a vacuum, and things are never really equal between companies. And just as an extreme example, Peloton investors who bought in July of 2021 at $125 per share after they just announced amazing growth of over 2x year over year probably don't think all those growth prospects were worth it, at least now, especially for a company that never made a profit and is currently trading at less than $5 a share. Just brutal. And I know that I'm cherry picking a really extreme example, and the reality is a lot more nuanced than that. Because you can have a company like Google or Amazon or obviously Berkshire Hathaway, and they've never paid a dividend, they reinvest profits, they buy back shares, and they've had amazing growth and success. But again, it depends on your exact timeline and where each company is at in their story. Because if you take the total return of the past 5 years between the following companies, Google, Amazon, Berkshire Hathaway, McDonald's, and Starbucks, you might be surprised at the results. Out of the 5, Google has had the best return out of all of them at 115%, which probably isn't much of a surprise. But then the next 2 best performers are the dividend payers, McDonald's and Starbucks at 80.86 and Starbucks at 77.09, respectively. And both of them have outpaced the total return of Berkshire Hathaway and Amazon over the past 5 years. So again, just because a company retains earnings and has a plan for growth doesn't mean that it's going to materialize in terms of a higher stock price. Sometimes just having a solid business that generates cash consistently is going to have a better overall return. It just depends on each individual business.